Hello everyone, this is Mohammed Saurabh and you are watching Evolve Search Virtual Learning. If you like our videos, then please subscribe our channel. Okay guys, let's go to the video. Hello everyone, in this video we will discuss about the basics of accounting, like what is accounting, how we do accounting, why we do accounting, and the process of accounting. Further, we will discuss about the debit and credit and what is the logic behind debit and credit. So all these basics things will be covered in this video. I especially designed this video for those students who have not commerce background and for those students who have medical and pre-engineering background. So this is a very simple video. So guys, you need to watch it till to the end in order to understand the concepts of accounting. Okay. So let's discuss about the accounting. First, we will talk about accounting. Okay guys, what is accounting? Company, what happened in a company? A lot of transactions happen on daily basis. Okay, a lot of transactions happen on daily basis, and these transactions generate a lot of bills, vouchers, and invoices. These transactions are based on bills, vouchers, and invoices, and then these transactions generate a lot of data in a company. So guys, being accountant, what we do? Being accountant, we record that data, classify that data, and finally summarize that data into meaningful format. Okay, let's discuss how we summarize the data into meaningful format and why we summarize that data into meaningful format. Okay, why we summarize data into meaningful format? Because it makes sense to the user of financial information. So guys, why we summarize our data into meaningful format? So that it makes sense to the user of financial information, so that they understand it and make their decisions accordingly. So who are the user of financial information? They are divided into two categories. Okay, one is internal user and second is external users. Okay, people who are within organization, they call internal users, like owners, managers, and employees. So when our information is generated, when it converted into meaningful format, the internal users use this information. How they use it? If he is owner, he will see whether he should invest more money into new projects or not, whether his company is providing satisfactory profit or not, and whether he should go for more projections or not. Such decisions are taken by the owners or investors. Okay, and if the person is manager, he will see whether he should hire more employees or not, whether the product is making more sales or not, and such decisions are taken by the managers by seeing the financial results. Okay, so the conversion of raw data into meaningful format is so necessary, because users have required that data and they could understand it when it is converted into meaningful format. Okay guys, what kind of decisions are taken by employees? Like if company is not making consistent profit and if their assets are not up to the mark, employees may decide to leave the company and join someone else. Okay, so such decisions are taken by internal users. Let's discuss about external users and how they use our financial results and financial information. Like if he is supplier, he supply goods on credit, he will see whether he should provide more goods on credit or not. He will look at our balance sheet and see how much money we own here before. Okay, whether will this company be able to pay back or not in the future. So such decisions are taken by supplier, whether he should provide more goods on credit or not. If he is lender, he will decide whether he should lend more money to this company or not. If our assets are stronger than our liabilities, then may he decide to lend us more, and such decisions are taken by the lenders. Okay, then in the same way, tax authorities also use our financial results, and they see whether we provided tax accurately or not. So such decisions are taken by these users. So how much it is necessary that our raw data should be converted into meaningful format. If it is converted into meaningful format, then they can use it, and then they can make constructive decisions on the basis of their data. Okay, so guys, we discussed about why we convert data into meaningful format. Now we will look at how we can convert that raw data into meaningful format. Okay, we discussed why we convert, and now we will look at how we convert that raw data, that vouchers, bills, invoices into meaningful format so that it could understandable to the user of financial information. So guys, let's discuss how we convert that data into meaningful format. Okay, we convert that data into meaningful format through income statement or balance sheet. Okay, through income statement or balance sheet. Let's discuss what income statement actually tell us. When we talk about income statement tell us about the performance of the business. For example, it consists on sales, expenses, and finally profit. Okay, and this profit is for a specific period. So income statement tell us about the performance of the business. Okay, now let's discuss about the balance sheet. Guys, balance sheet tell us about the position of the business. For example, it consists on assets, liabilities, and equity of a business, and this data is historic data. That's why balance sheet tell us about the position of the business. Okay, through these two statements, a user of financial information make too many constructive decisions. Okay, whether these decisions are related to investment or lending money and etc. Okay, so let repeat it again what actually we do in accounting. We convert raw data into meaningful format, and on the basis of that meaningful formatted data, decisions makers make their decisions. Okay, and these decisions could be related to investing more money in the business, or it could be related to lending more money to the business, or it could be related to providing more goods on credit or not. So such decisions are taken by the user of financial informations. Okay, guys, let's discuss about the elements of accounting. Okay, we have just 5 elements and it's nothing more to understand. Okay, if we understand these 5 elements, whole accounting will be piece of cake for us. Okay, if we understand these 5 elements of accounting, whole accounting will be like a piece of cake for us. Okay, now let's discuss each of elements here. First, we talk about asset. What is asset? Guys, assets are resources which owned and controlled by an entity and that results from past event which future benefit are expected. Okay, so what is asset? Asset is resources which are owned by entity and controlled by entity. What does this mean by own and controlled by entity? What we understood through the definition of accounting, it is not necessary that asset should be the ownership of the company. Asset could be controlled by the company. Like if we take an asset in through lease, then we will not have ownership of that asset. Okay, we will just control that asset. We understood that assets are something which owned and controlled by entity that results from past event. Okay, what does this mean? Past event mean that in the past we may purchased it. In the past, may owner has invested money in the cash, or owner has taken some liabilities from the lenders. So these two sources has increased our assets, or these two resources become the cause of our assets. Okay, so any resource that benefit us in the future called asset. Okay, Like if I pay salary in advance to employee, that salary will be called as asset. Why I call it as asset? Because that employee will give services in the future, so the benefit will be expected in the future, so that salary will be called as asset. Okay, so in the same way, if I paid rent in advance, so I will take benefit in the future, so the paid amount will be called as asset. Why? Because so far I have not taken benefit, and it is expected that I will take benefit in the future, so the paid rent amount will called as asset. So what we understood here, we understood that assets are something which benefit us in the future. Okay, now we will discuss about expense. What is expense? Expense is the cost of operation that a company incurred during operation, from which no future benefit is expected. Okay, so what is expense? Expense is cost for a company. Okay, for generating revenue we must consume our resources. Okay, for generating revenue we do operations, and during our operations we consume our assets, so the consumed amount of assets called expenses, and from that consumed amount we have no benefit in the future, so that consumed amount called expenses. Okay, so what is the difference between asset and expenses? Assets give future benefit, and there is no future benefit expected from the expenses. Okay, like if I paid salary to an employee for the previous month, so that salary will be called as expense. Why? Because I taken services from that employee here before. Okay, here before I have taken services, so employee will not render more services against that paid amount. In the same way, if I paid rent for the previous month, that paid amount will also called as expense. Why? Because I have already taken the benefit against that paid amount of rent. So what is the difference between assets and expenses? Assets will benefit us in the future, and expenses, from expenses there is no future benefit as expected. For example, if a company has cash, it is its asset, and it has paid salary to one of his employee 40,000, and whatever amount has consumed from the asset, so what is the remaining amount? Remaining amount is 50,000 less 40,000, remaining amount is 4,60,000. So whatever has consumed here, that consumed amount called expenses. So this was the earlier balance of a company. The earlier balance of the company was 5 lakh, and out of which company has paid salary to one of his employee 40,000. So asset has consumed with 40,000, with the amount of 40,000. Okay, and the remaining amount is 4,60,000. So the consumed amount is our expenses, and the remaining amount called our assets. Okay, so guys, previously we have studied that assets are something that company own, but now the definition has revised. For example, many times we put machineries, furnitures on lease basis, so that lease item will also called as asset. Okay, so guys, let's discuss about the another element of accounting, that is liability. What is liability and how it is generated? Okay guys, liability is present obligation of the company that will outflow an asset of the company in the future, and it is result from the past event. Okay, so what we know about obligation, what we know about liability? Liability is present obligation. Okay, for example, in the past, if I purchased goods on credit, and if I taken loan from the bank, so such events has created liability. So now whatever I did in the past, it is in present it become an obligation for us. Now for settling this liability, we must outflow our asset. Okay, so in order to eliminate this obligation, we must have to outflow our asset. Okay, so when we will outflow our asset, that asset will decrease our obligation. For example, when I will pay to the lender or supplier, then that payment will outflow my asset, and that payment will decrease the amount of liability. So what is liability? Liability is present obligation, but this present obligation is resulted from the past event. Okay, in the past I did purchases, in the past I have taken loans from the bank. So such events, such consequences has created some obligations and liability on the business. So businesses owe to pay others. Okay, businesses owe to pay others. So it is outsider claim. Whatever assets we held, it is the outsider claim on our total assets. So let's understand this liability more clearly here. So guys, like we have the equation of accounting is assets equal to liabilities plus capital. For example, in assets we have 5 cows. Okay, so out of these 5 cows, I purchased 2 cows through liabilities and 3 cows from my own invested capital. So on this 5 cows, 2 are being claimed by the outsiders. Okay, 2 are claims by the outsiders because I have taken some loans and I have purchased some cows through this source. So because I taken these 2 cows from liability source. Okay, so it is the claim of outsider on my total asset. Okay, so what is this? This is a claim of outsider from our total liability, so total assets. Okay, so these 3 cows are claimed by the owner, but these 2 cows are claimed by the outsider. So whatever assets we hold, we have 2 sources to finance those assets. Okay, one source is liability and second source is owner capital. Okay, liability is outsider claim on our total asset. Outsider claim on our total asset. Here the claim is for 2 cows. Okay, guys, when we talk about the equation of the accounting, when some farmer in Italy decided to record whatever they hold in their farmhouses, so what they did, they started recording their cows. So first they recorded their cows, and then eventually after a few years they decided they should record the source of cows that they hold. Like, it is not necessary the cows they hold they own it. Maybe they purchase those cows from taking loan from others, from taking some money from others. So what they did, they decided to record the sources of their assets. How many cows they purchased from their own sources and how many cows they have purchased from the other sources. Okay, so what they did, they said that whatever they purchase from other sources, they call it as liability, and whatever they purchase from their own sources, they will call it as capital or owner equity. So this is how the accounting equation has generated. Okay, so what we understood here, that the sum of liabilities and equity must be equal to the sum of our total assets, because these total assets has generated from 2 sources. One is liability and second is capital. Okay, when we will decrease our liabilities, they eventually decrease our assets. When we will decrease our equity or capital, it will eventually decrease our assets. So there is an association between our assets and liabilities plus capital. Okay, Okay guys, let's discuss about the fourth element of accounting, that is capital or equity. What is capital? Capital is the amount which is invested by the owner. Okay, it is the claim or residual interest of the owner after deducting all liabilities. What this mean, residual interest? This means that whenever a business go for liquidation or shutdown, when it will sell its all assets, they will pay first to their creditors. Okay, first they will pay to their liability holders, and whatever left after payment to liability holders, that amount will be paid to the owners or claim or people whose claim is second. Okay, so what residual mean? Residual mean first we will pay amount to all obligation holders. Okay, first we will pay all amount to liability holders, so whatever left after that, then we pay that amount to the to our owners of the business. Okay, so what is this is what the difference is between outsider and owners. So outsider has first claim on our assets because we pay them first whenever a business go for liquidations. Okay, so and the second claim on our asset is owners and investors. Okay, then we pay to stockholders after payment all, after making all payment to our liability holders. So this is what the difference is between outsiders or owners. The amount which is injected by the owners in the business called capital. Okay, the amount which is injected by the owners in the business, it is called capital. So we have two sources to increase our assets. One is liabilities and second is capital. If owner bring money into the business, this will increase our assets, and if owner take some liabilities from outsiders, this will also increase our assets. So this is how our assets are associated with these both. Okay. Oh yes, let's discuss about the fifth element of accounting, which is revenue. So the fifth element of accounting is revenue. What is revenue? Revenue is inflow of cash or receivable during the ordinary course of a business. Like when we made sale to our customers and when we provide services to our customer, that will generate some revenue. They can pay us on the same time, but they may promise us to pay in the future. So the amount which we receive in the future called receivable. Okay, what is a receivable? The amount which we will receive in the future and others are owed to pay us in the future, that amount called receivable. Okay, so revenue could be in the form of cash or it could be in the form of receivable, that amount which we will receive in the future. So revenue are generated from many sources like selling products or providing services, rendering services. Okay, so like if it is hospital or it is airline services, then they will not provide product, they will just provide services, and against that they will generate some revenue. And on the other hand, if it is manufacturing firm, they will sell their product and against that they will generate revenue. So revenue is what? Revenue is the amount that inflow during the ordinary course of operation of a business. So guys, hopefully this was a nice session for you all, and in the future we will come back with the new videos.